And I don't know if you can spot the Jackson Hole speech on the chart.
I think it's that big red bar, right?
It's pretty obvious. Over a 3% down day, the market did not like what they heard from Powell. Continued to trend down since then, almost entirely down. Broke out below the 50-day moving average, which ended up being pretty tough resistance the past couple days. Those high wicks did bounce off of that number. A technician's not going to like the chart. You got the 50-day average moving down, 200-day average moving down, the RSI, which is a short-term oscillator on the bottom, moving down as well. It does tend to bounce off the 30-day, so if it can get a short-term bounce from some smaller up days, that basically means the market is getting too oversold as the measure reads. Maybe you'll start seeing some more technicians come in, but it's not a good chart.
No, from a technical standpoint. And we can see that prior to that big red drop, there was a nice green update. So what was happening is the market expected the Fed to pivot, not to be hawkish, not to raise rates, but they came out of Jackson Hole like a hawk. And whenever we're looking at Powell, what he was saying is he needs to get inflation at a sustained period of below trend growth, meaning back to that 2% or below. And he's very aware of the softening labor market. And I think that's the reason the market expected to see a slowdown in rates. But that didn't happen, and he's acknowledging that he expects some pain for the households and small businesses. So they really came out with a very hawkish tone, while the market expected this pivot or some more accommodation.
Yeah, the market wanted to hear, something about the economy, long-term forecasting, something like that. Instead, they got short-term, 8-minute speech about inflation. And Powell knew what was going to happen with this speech. It was a very intentional speech, and I think he did it because of this next chart, which is national financial conditions. So looking back at this, it's just a measure, and I like to pull measures from some of the other Fed banks, the regionals, because they're probably all looking at this together and talking about it. And the way this chart reads is 0 is a long-term average. So when you're at, that 0, you're either not really loose or tight. When we're below 0, which we were in January, conditions are loose. And as you start moving up higher, they're tightening. And then above 0, their conditions are actually very tight. And we can see the last 2 months, we've seen loosening in the system. So this is the market, mortgage rates dropping from 5.8 back down to 5 in this time period. And these measures are made up of 150 other measures that we talk about all the time, from yield spreads, high yield spreads, mortgage rates. The stock market is in here. Basically, the market was fighting Powell. They were going against what the Fed was saying, and they didn't like this. It does not help the fight against inflation when the system is getting looser. So he wanted to try to talk this down, try to get conditions to get a little bit tighter. I think that's why he delivered the speech.